transitory, what we will be talking about is employee benefits. So this is the chapter 9 of SBR, Strategic Business Reporting, and then we'll talk about how the accounting treatments for defined contribution plans, defined benefit obligations are accounted for, or you could say short-term benefits or long-term benefits, how they are accounted for, and then what is defined contribution plan, and then defined benefit plans. After that, we'll talk about the gains and losses on curtailments, how they are treated, along with asset ceiling test and reporting actuarial gains or losses. So let's talk about short-term and long-term benefits. So when you are talking about employee benefits, there are 4 types of employee benefits: short-term employment benefits, long-term employment benefits, termination benefits, and then post-employment benefit. So upon post-employment benefit is the most important thing that we will be talking about, and then we will be doing some questions regarding that. So this is within short-term. This is within post-employment benefit, the contribution plan, and defined benefit plans. So what happens? What is the difference between contribution plans and defined benefit plans? So the main difference is that contribution plan is like, it's not managed by a single entity, which is the provider. It's like, suppose this is A is the employer, and then B is another entity. So what they do is they every month contribute some money. So it is they provide it to B, and then after that, at the end of their retirement period, they get the money from entity B. So that's the sole purpose of this. So it's basically what we normally do is, in terms of accounting treatment, is just employee expense, and then that's it. We don't have to do anything more than that. So whereas in case of defined benefits plans, it's like the employees do their service, and then after that, when they leave, and then when they reach 60 years of age, then we have to guarantee their pension. Whereas in this case, we don't guarantee. In contribution plan, we don't guarantee, so there is no further obligation. So what happens is, normally, that in terms of Nepal, what happens is SSF, Social Security Fund. In that case, what happens is the employee contributes 10%, 11%, and the employer contributes 20%. After that, there is no further liability. Whereas the ones which are run by the government are these ones, defined benefit plans. So after the employee has done their service, the government has to guarantee they receive their pensions. So that's the main difference. So in this case, there is obligation. They could, in this case, there is no further obligations, whereas in this case, there could be further obligations, because defined benefit plans is like a different fund that you create, and then sometimes the obligation may be greater than the assets, so we have to contribute some money towards it. So that is our further obligation, right? So that's the main difference. Whereas in case of actuarial gains or losses, account for gains or losses on curtailments. Curtailments is usually what happens is when there is a redundancy or some departments is shutting down. So what happens is you make the settlement, so you don't have to pay the years of service cost. So your service cost gets reduced. So there will be gain, or there could be losses as well. So that's what we account for. It's usually charged to profit or loss. And then after that, asset ceiling test. So asset ceiling test is the plan assets that you have within this defined benefit plan, plan assets and present value of future obligation. Suppose this is 2 and the present value of obligation is 1. So you have a plan assets of 1, right? So this is net plan assets. So this is 1, and then suppose this assets can only generate 0.5 as a return, then what we have to do is lower off both of these. So we cannot use this one, the plan assets, which is the difference between plan assets and future obligations, because it can only generate 0.5 of the return. So that's why we have to use the below figure. So it's always lower of these two. This is return on assets or decrease in future present obligation. So lower of these two. So that's the most thing. So we will be doing some problems regarding it, so it'll be more clear in that way. So let's look at the types of contribution plans. Not contribution plans. Let's look at the employment benefits in overall. Types: post-employment benefit, short-term, termination benefit, long-term. So post-employment benefit is again further classified into two types: contribution plan, contribution benefit, defined contribution benefit, and then defined obligation, defined obligation benefit. And then short-term benefits are sick leave and then all these short-term related things. So it's basically like sick leave and stuff like that. And then whereas termination benefit is like when you actually are made redundant. So in that forceful redundancy, what you actually get is a big sum of money, and then that's pretty much it. So that is termination benefit. And what is long-term benefit? It's like long-term disability allowances, and then other sort of forms of long-term payments. So that's the most aggregate, I guess, difference between them. And then the most important thing is what we'll be talking about is post-employment benefit. So this is where the calculations occur. So it is classified, post-employment benefit is classified into two types, right? So defined contribution plan. So what is defined contribution plan? It is a plan which is managed by a different entity and is paid by that entity after reaching a certain retirement age. And does the company have a further liability? No, the company doesn't have any further liability. So what happens is normally it is same as employee expenses, so it's included within employee expenses. So that's how it is expensed, charged to profit or loss, or SOPL, charged to SOPL, and then no further obligation. So suppose the another entity which is managing that fund, it's not able to generate the return, quite adequate return to pay the obligation, then you don't have to worry about it. There is no further obligation. Whereas in case of defined benefit plans, what happens is you have a further obligation. That's the most important difference. So after that employee has worked for, let's say, 20-30 years, and then he retires at 60, and then he normally gets a pension of his salary into numbers of year work divided by 60. So he'll get that amount of pension, and then if the pension liability is higher than the plan assets, then the entity has to further contribute into the scheme. So the basic accounting for defined contribution plan is just expensive from statement of profit or loss. Whereas in this case, in defined benefit obligation, there is a different method of calculation. So how is this actually calculated? It's salary at retirement into number of years worked divided by 60. So it's salary into numbers of years worked divided by 60. So this might change as well. So this might change. Suppose an employee has retired at 20,000 salary. So next year, suppose there is a increase in salary. So his salary or what we can say is our pension obligation will also rise. So we'll talk about that. So what we will do is we'll make a simple format in which we'll call reconciliation. So reconciliation. Present value of obligation, fair value of plan assets. The difference is net obligation or assets. So it's present value of defined obligation minus fair value of plan assets. Suppose if the present value of defined obligation is greater than the fair value of plan assets, it's a deficit. So deficit is net defined obligation. Whereas if the present value of defined obligation is smaller than fair value of plan assets, then it's a surplus. So since we are deducting assets from liabilities, so we'll have a negative here. And then what we will add to this is net interest paid, net interest component. This is the interest because this is normally at the start of the year. So what we'll have to do is we will have to compound it. So take this figure from this date to at the end. So there will be some interest cost. So that will be over here. And then this will go to SOPL. Then next is service cost. So service cost includes past service cost, and then present service cost. So there might be some differences in that because due to salary hikes, so the past service cost might increase. So that will be a part of service cost, and then gains or losses on settlement, that will also be a part of service cost. And then after that, contribution into plan. So what this net interest component will do is it will increase our plan obligation more because the present value of defined obligation at this date is smaller than the present value of defined obligation at this date. So we have to account for that changes as well. So that is our interest component, right? So that will increase our liability. And then service cost is as well, it will increase our liability. And again, contribution into plan is minus because it actually deducts our liability. When we contribute into the assets, our obligation gets lower. And then benefits paid. is 0. Why? Because it has simultaneous true effect in the plan assets as well, in the obligation as well. So what that normally does is, so suppose when you pay out an employee, what that normally happens is like the plan assets get reduced, right, along with the obligation. So there is net effect, zero effect, because we are currently looking at the difference between assets and liabilities. So since there is a zero effect, so we don't have to actually account for it. They nullify each other. So it's 0. So whatever amount you get, and then you have your closing or closing net liability, net benefit obligation. So when you deduct this amount by this, you get a positive figure or negative figure. This is the remeasurement component. So this is taken to OCI. So this goes to OCI, this goes into SOPL, the net interest component goes into SOPL. Whereas the contribution into the plan is nothing else than just moving the cash from cash to the plan. So it doesn't have any accounting entry. We don't have to do any accounting entry. So the only thing that we got to remember is that we need to know the interest rate. So by which rate should we actually multiply, what's the multiplication factor should be our primary concern, and take that to SOPL. And then service cost. Service component consists of 3 different things: gains or losses on settlement, past service cost, which might change due to improvement in the plan, or current service cost, which might change due to redundancy or any other factors. And then contribution into plan, it basically reduces our liability. So since it is a defined benefit obligation, we are assuming it's a defined benefit obligation, because normally it's always in deficit, because see, the salary past service cost increases, right, with every salary hike, right? So we don't assume that the salary will go down, right? So the past service cost is not going to come down, so it's only going to go up. So it's always in net deficit. Whereas if it would have been an asset, then contribution into plan would have actually increased the asset. Okay. So defined benefits paid, what that does is it actually reduces our plan assets along with our obligations, so it has zero effect. So it nullifies each other. And then the amount that you actually get out of here is your net benefit obligation, which is the movement after adjustment. So once you deduct that by closing net defined benefit obligation, in your remeasurement component, it can be segregated into 2 parts, because remeasurement component consists of actuarial gains and losses. Remember, these are the assumptions which are made by actuaries, because they do a lot of demographic studies. Based on that, they normally calculate how long the person is going to live, and then they calculate their obligations for us, and they give us the figure every year. So we have the opening figure and the closing figure, right? So what we will do is, when we are actually subtracting closing by opening figures after adjustment, so the remaining is the gains or losses of actuary, right? But there is another component towards it. There is a difference between return on net assets and the actual assumptions that we made. Suppose the interest component that we have taken to SOPL is 11%, but what we get on our assets is 12%. Then there is a difference figure, right? So that is also a part of remeasurement component, because the return on assets is greater. So there is 2 components to remeasurement component. So there is actuarial gains or losses and the difference between assumed rate of return and actual rate of return. So that's more important. Let's look at some problems, and that will give us some more conceptual clarity on this thing. So let's look at this T value 4 by TC. So what's our present value? So we have been given the net obligation at the end of the year. So our beginning is 31st March 20x2 and then our ending is 31st March 20x3. So let's put the values in and then let's calculate it. So what's the values? 55 million at the bottom. 55 million is our obligation at the end of the year over here. 55 million. And then what's our net obligation over here? It is 100 minus 52, 48. So what's our interest component? How much is our interest rate? It says 6.25. So that's our discount rate. 6.25. And then what we will get out of this is 6.25. So 48 into 6.25 percentage. Three. So this is our interest component. So what's our service component? Let's look at it. So the current service cost is 12 million. And then PC granted additional benefits to those currently receiving benefits that are due to vest over 4 years, which have a present value of 4 million. So what they actually did was they upgraded the scheme. So that will add to our service cost, right? So this is current is 12, additional is 4. So additional is 4, total is 16. Our contribution service cost is 16. So what's our contribution into the plan? What that normally does is it reduces our net obligation, right? So contribution into the plan is contribution made of 8 million into the scheme. So 8 million, right? So that will be negative. What will happen to defined benefits paid? It will be 0 because it will reduce our benefits as well. It will reduce our defined benefit obligation as well, and then it will definitely reduce our plan assets too. So the effect is nil. So we write 0 over here, and then what we will get out of this is, let's add this thing. So 48 plus 3 plus 16 minus 8, 59. So 4 is our negative figure. So since we know it is 4, we have to divide this into 2 parts. We have already discussed about it. It's actuarial gains and losses, or it is the actual return on assets rather than the assumptions. So we were supposed to get 3.25 returns, but in the question it clearly says that we got a return of 4. So what's the difference between them? 0.75. 4 minus 3.25. So this is our actual return. This was our expectation, but our actual return was greater than the expectation. So we have to actually classify this to actuarial gain or loss. Now is 3.25, and then difference between the return is 0.75. So this is taken to OCI. So we have to actually differentiate it, segregate it as well. And then this service component goes to SOPL as well. So this is basically how you account for this kind of problem. So when we are doing that asset ceiling test, what we have to look out for is the lower of value. So which is what this means is like you only have to write the surplus that you can actually get out of it. So that's the main concept behind it. What does that mean? So that means it should be lower off of normal calculation as normal, or present value of economic benefits available in funds in form of refunds or reduction in future contributions. So that should be our assets surpluses. So it should be lower off. So what that actually means is, suppose the present value of obligation is 850, fair value of plan assets is 950. So there is a surplus of 100, right? But if that plan assets, this plan assets 950 can only generate 70, which is present value of economic benefits that it can generate, then what we have to do is we have to actually take this 70 as the surplus. We can't take more than that, because even though the present value of obligation is lesser than the fair value of planned assets, the return that the assets can actually generate is only 70. So we have to take 70 only. So that's the main thing about this. So it's always good to remember lower off calculation as normal, or the present value of economic benefits available in refunds or reduction in future contribution. So suppose what this normally means is, like, the fair value of plan assets is 950, right? So the return that can generate is 70. So that means it does reduces the future contribution or future liability too, right, by 70. So that's our value for illustration 4 or 5, something like that. But this is just a normal example. So asset ceiling is mostly capped at the amount which the planned assets can generate in form of refunds. That's more important. And then after that, so it can only be, so whichever is lower off, calculations as normal, or the reduction in future liability, or present value of economic benefits. So that's it for today, guys. If you've got any other questions, please do comment down below. I'll definitely answer it for you. Until next time, bye bye.